America just passed $38 trillion in debt. Washington says everything is fine. The 1% are already executing their exit plan. Let me walk you through it. Welcome back to Wealth Architect. I'm Dr. Ben. If you're tired of the same recycled advice that keeps most people running on the same treadmill while the rules quietly change, you're exactly where you need to be. Today, we're breaking down the $38 trillion debt number that just hit headlines and showing you the precise moves the wealthiest families are making right now to protect and grow their capital through it. This isn't scare talk. This is the same blueprint I've seen working for the people who actually own the assets instead of just managing them. Stay with me through every section. I'm laying out the full picture, the history that proves the pattern, the exact strategies they use, and the 3 moves you can start before summer ends. By the time this episode finishes, you'll have a complete roadmap you can put into action. Let's get started. The debt reality check. Let's start with the numbers everyone is seeing but few are connecting to their own bank account. As of right now, in March 2026, the official U.S. national debt stands at $38.86 trillion and climbing by roughly $7 billion every single day. That's not a rounding error. That's more than the entire GDP of every country in Europe combined. Interest payments on this debt are now running higher than the entire defense budget in many recent years. Think about that for a second. The government is spending more just to service the old debt than it spends to protect the country. Every time they roll over another chunk of that debt, they have 3 choices: raise taxes, cut spending, which never happens at this scale, or print more dollars. Here's what that actually looks like for you and me. Every new dollar printed quietly reduces the purchasing power of the dollars already sitting in your savings account, your 401k, or your index fund. It's a silent transfer of wealth from the people who hold cash and bonds to the people who own real assets that can adjust with prices. Let me put real math on it. If inflation averages just 4% over the next decade, and many economists who watch this closely expect higher, a $100,000 nest egg today will buy only about $67,000 worth of goods and services in 10 years. That's not theory. That's what happened to savers in the 1970s when debt levels were far lower than today. The average family trying to follow the classic save 10% and wait 40 years plan is essentially volunteering to fund this system with their future buying power. Meanwhile, the people at the top who saw the writing on the wall years ago already moved their capital into things that can't be printed away. This isn't a political point. Both sides have contributed to the climb. The system is simply working exactly as it was built, to reward those who own productive capacity and penalize those who only hold promises on paper. If you're still 100% in traditional retirement accounts that track the broad market without any adjustments for this reality, you're positioned exactly where the system wants the majority to stay. Lessons from history that repeat. This pattern has played out before, not once, but across multiple empires that reach the same debt-to-GDP thresholds we're crossing now. Understanding these stories gives you the confidence to act instead of hoping the next election fixes it. Take the Roman Empire in its later centuries. They started debasing their currency, taking the same silver coin and mixing in more and more base metal until it was barely silver at all. Inflation exploded. The people who held only coins and government promises lost everything. The families who owned farmland, trade routes, and productive workshops not only survived, they became the new power structure. They bought distressed assets at pennies on the dollar when everyone else was panicking. Move forward to the Spanish Empire. They brought in mountains of silver and gold from the Americas, yet defaulted on their debt 9 separate times between 1557 and 1662. The kings spent faster than the treasure ships could unload. The banking families in Genoa and elsewhere who had financed the crown went bankrupt with them. But the merchants who quietly shifted into land holdings, private shipping companies, and businesses that could raise prices with inflation came through stronger. They understood that paper claims on government eventually fail when the math stops adding up.
The Ottoman Empire in the 1800s followed the exact same script. Massive borrowing to fund endless wars and palaces led to currency destruction and a slow decline from world power. The elites who owned real productive land and international trade networks protected their wealth, while ordinary citizens watched their savings evaporate. We saw it again in Britain after the Napoleonic Wars, and again after World War II. Debt to GDP ratios hit levels many called unsustainable. The families who owned factories, real estate, and commodities preserved their capital. The ones holding only war bonds and cash saw their real wealth cut in half through inflation and devaluation. Closer to our time, look at Argentina in the 2000s or Venezuela more recently. When debt service became impossible, governments printed their way out. The people who owned farmland, gold, or businesses that served basic needs kept their lifestyle. The middle class that trusted bank accounts and government bonds lost decades of progress in a few years. Every single one of these examples shows the same sequence. Debt explodes, politicians promise everything is under control, inflation becomes the hidden tax, and the owners of real assets come out the other side. The 1% today are simply repeating the winning strategy that has worked for centuries. Inside the 1% exit playbook. So what are they actually doing right now while the rest of the world watches headlines? They're not hiding in bunkers or selling everything. They're quietly building 3 overlapping layers of protection that most people never see. Layer 1 is hard assets that hold or increase value when paper money loses purchasing power. Productive real estate that generates rent, commodities like gold and silver that have been money for thousands of years, ownership in businesses that can pass on higher costs to customers. These aren't speculative trades, they're cash flow engines designed to outrun inflation. Layer 2 is geographic diversification. They spread capital across borders into countries and currencies not tied to the same debt spiral. This isn't just buying a few foreign stocks on a U.S. brokerage. It's direct ownership in stable foreign real estate markets, private businesses abroad, and assets denominated in currencies backed by stronger fiscal positions. Layer 3 is legal and structural protection. They wrap these assets inside trusts, family-limited partnerships, and specialized entities that shield wealth from future policy changes, higher estate taxes, and potential creditor claims if the system ever needs a reset. This layer turns their wealth into something that survives political cycles instead of depending on them.
These aren't theories I read in a book. These are the exact structures I've discussed with guests on this channel who manage 9-figure and 10-figure portfolios. They treat government debt like a predictable weather event and build their holdings to thrive no matter which way the storm blows. Your 3 moves before summer. You do not need billions to start using the same logic. Here are the 3 specific moves you can begin in the next 90 days while the window is still wide open. I'm going to walk you through each one step by step so you can actually implement them. Move number 1. Build your inflation shield. Shift 15 to 20% of whatever capital you have available into assets that naturally rise with prices. Start with physical gold or silver if you want something you can hold in your hand, or use low-cost ETFs that track them. Move into commodity-producing companies that pay dividends. Consider direct rental properties or real estate funds that focus on cash-flowing assets rather than speculative flips. Step 1. Open a brokerage account that lets you buy these easily if you don't have one. Step 2. Calculate exactly how much you can move without disrupting your current life. Step 3. Buy in small, consistent amounts, so you're not trying to time the market perfectly. The goal is steady income or appreciation that keeps pace with rising costs. Even a modest position in a royalty trust or farmland fund can start this engine today. Move number 2. Add geographic distance. Get exposure outside the U.S. dollar system. Look at quality real estate in stable markets like parts of Canada, Australia, or Singapore, where fiscal policies are different. Use international ETFs or directly hold shares in strong foreign companies.
Many brokerages now make this simple with no currency conversion headaches. Start by researching 1 or 2 countries whose debt levels are manageable. Open the necessary account forms, most take less than a week, and allocate a portion of your portfolio to these assets so that if U.S. policy shifts dramatically, not everything moves in the same direction. The point is balance, not abandonment. Move number 3, lock in protection and cash flow engines. Set up a simple LLC or basic trust structure around any new assets you buy. At the same time, expand or start a side business that creates cash flow the government can't easily dilute. Consulting in your expertise, digital products, or a small local service. These become your personal safety net. Do the paperwork now while rules are still favorable. Talk to a competent accountant or attorney who understands asset protection. I can share resource lists in the description. Then focus on building the business so it throws off monthly income you control. Combine this with the first 2 moves, and you've created a complete system that works even if the broader economy gets rocky. Building your full protection blueprint. Now let's tie everything together into one complete picture. A sample allocation might look like 50% in productive U.S. assets, 20% in hard commodities, 15% in international holdings, and 15% in your own cash flow business. Adjust based on your age and risk tolerance, but the principle stays the same. Own things that produce, not just promises. I'll also walk through how to review your current portfolio to spot the weak spots, the pure paper assets that will suffer most. We'll cover common questions like, what if I'm starting with only a few $1,000s, and how do taxes work with these moves, so you leave with 0 guesswork. Common pitfalls and how to avoid them. Before we wrap up, let's cover the mistakes that catch most people. Trying to do everything at once and burning out, chasing flashy investments instead of steady cash flow ones, ignoring the paperwork and leaving assets exposed. I'll show you the exact checklists I recommend so you sidestep every one of these. Real-world case studies. Listen to what happened to 3 different people I've worked with or studied closely. One family shifted 20% into real estate and gold in 2021 and preserved their lifestyle through the inflation spike. Another business owner added international exposure and saw his portfolio hold steady while the market dipped. A third started a small digital product business on the side and now has monthly income that covers his entire family's expenses. Their stories prove these moves work at every level. The debt reckoning isn't some future event, it's already here. Washington will keep saying everything is fine, while the 1% finish repositioning. You now hold the complete blueprint they use. The only question left is whether you start applying it before the next round of inflation or policy changes makes the moves harder. If this episode gave you clarity and a path forward, leave a comment telling me which of the 3 moves you're starting first. I read every single one. Hit the like button if you want more episodes that deliver the real 1% playbooks instead of the usual employee advice. Subscribe and turn on notifications because a new blueprint drops every week. Next episode, we're going even deeper into another asymmetric opportunity most investors completely miss. Until then, stop simply managing money and start designing your freedom. I'll see you in the next one.